Yeah, thank you, Tara, for the introduction, and welcome to all for the last possibly webinar from my side during this calendar year, and what a year it's been, right? So lots of ups and downs, and after a good previous year, I think this year has been a year where we've seen the other side of markets. Uh, so coming back into, and this sort of chart tries to capture all the ups and downs, and you can see the graph basically is really all over the place. Okay. And we started off relatively weakly because markets between, December, and March was very volatile, and, markets also corrected reasonably well. Okay. And that was also a little bit thanks to, uh, a lot of the geopolitical and, Trump tariffs and various other things, in the making. So, so that there was volatility which, got created there. But interestingly, post that markets, came back, and in December it came back to all-time highs, right? Now, uh, is all-time highs good or bad? Okay, obviously it's always good, and but however, it means that you're just coming back to where you were. Okay, and this it's sort of coming back to where you were, about a year back, right? So to that extent, if one sees in terms of growth, there is no growth. Of course, yeah, again, we will go down into detail. This is the Sensex, right? Now, what about some of the other indices, whether it is mid and small cap, etc., they not necessarily did as well. Okay, especially small caps, have seen very significant falls, and we will see as we sort of go forward, right? And so coming back to sort of looking at what is in some form what has the year been, right? If one looks at the Nifty, considering that there was a fall from, say, October of 2024, right? Nifty is showing, a return during the YTD period, that is from Jan 1st of 25 to date, right? Interestingly, in this phase, we have significantly underperformed emerging markets, okay? And we will also see a slide, country-wise, and how global markets have done. But yes, we have significantly sort of underperformed emerging markets. Okay, we've also underperformed, global markets as well, developed markets. So broadly, India has been a laggard. Not only the Nifty, but even the currency has been a reasonable laggard. And at a time like this, medium duration, fixed income has done better than Nifty. Okay, that says it all, right? Yeah, so that has been there. Yes, the star of all of this has been silver. Silver has seen staggering, 126% type of growth in this period, and it's also seen volatility, out there. But broadly, silver has been a star in terms of a performing commodity, right? And gold has been, reasonably uh, strong, possibly the second fastest, after silver. So that's something which was the defining year of 2025. Uh, Interestingly, if you see, India was, right at the top end. If you looked at it about 18 months, right? If you saw, uh, at that time, I remember we were, second to Nasdaq. Nasdaq was the best performing index, and sort of next was the Nifty. Okay, in this period, you will find that Nifty has probably, uh, you know, second worst. Okay, if I look at a 1 year period, and interestingly, because this 1 year has been, pretty muted, while other markets have sort of been reasonably strong in this calendar year, the 3 year also has got impacted. So of course, 3 year we are probably a little away from the middle, but it is still been lower, keeping in mind the poor performance of this calendar year. Okay. Now, if you look at and this is what I think a lot of clients has come, and investors also on TV shows, etc. Come back and ask, market is at a high, but you know what? Why is it not reflecting in my portfolio? Right? The market returns have been a little skewed, in terms of uh, how the stocks have performed, and secondly, at a stock level. So this is a chart from Kotak, and they brought it out very nicely that this is for a period which may be 20, yeah, it is 28th November, so it's not as of now. Okay, you would find that the Nifty was sort of flat. Okay, but the constituents, okay, if you looked at and what are we talking about drawdowns, we're saying from the high how much it has fallen, right? So the Nifty was sort of 0.5% from the high. So earlier I was talking from December to date, right? So here I'm talking about from the high, sort of, we were in, as of November, 28th, we were 0.5% down. We subsequently went past the high, but it's a good reflection, and you may have a percent or two differential from here. But if you looked at the individual stocks, okay, if I just look at stocks and where have they fallen from their individual highs, and what's the average of that, right? The individual stock falls have been 7% down. So what this basically means is that there's been a good sectoral rotation, okay, like what we say. So one sector is falling, and the other sector is sort of coming up. They're not necessarily falling and going up in sync. Okay. So which is why at a Nifty level, maybe we are 0.5% down, but actually, if you look at the stock constituents and you say from the high of, let's say, Reliance to the bottom, right? What is the drawdown? Okay, what is it? Okay, and versus, let's say, the index. So like that, you look at Reliance, you look at Tata Motors, and you keep on looking at all the stocks in the Nifty, and then you will come back and say, okay, this is the average. So that average is 7%, right? And actually, if you go down to almost like the small cap, okay, the this is almost like 23% down. Okay, and if you even went to the Nifty 500, right? Which is slightly wider. It has almost like it has 500 stocks. Okay, that the weighted average has been of the drawdowns has been 18.5%, which means individual stocks have fallen 18.5% from the peak on an average, all the Nifty 500 stocks, right? So that's something that is, a rational way of explaining why individual portfolios, may not be in line with the, Nifty, because say even the Nifty has 50 stocks, right? So individual portfolios would have, say, depending on the, fund, maybe anywhere between, say, 20 to, say, 30 stocks, say, in a mutual fund, right? Or even 35, 40. But very rarely you'll find, 50 stocks out there, right? Unless it's an index fund. So that is the point, that because you cannot have the whole concentration, and the sectoral rotations won't play out exactly as the underlying index, you will find that the deviations are larger. And you can see that the most one of the more significant deviations are coming on from the Nifty 500. That is because the there's a whole set of 500 stock which is there. So you will also find that at a portfolio level, the index has 500 stocks, and you will still have, say, that 25 to 35 type of stocks. So that is the point to keep in mind, why there is a difference. And it also happens that sometimes the stocks that did very well for you also are the ones that ended up correcting the most. So we found even one of our portfolio, super value, had a 15% alpha at one point of time, which means we beat the index by 15%. But then those stocks which really went up sharply for us also, saw profit booking and corrections, and so that sort of took away some bit of the returns. So that is the point that is there, and sort of drawing that further, if you go back and look at the small cap, it is staggering. Okay, so and this one is looking at 2018 to 2020, right? We had a mid and small cap crash that we saw. And it was interesting that 91 Capital actually came out with this analysis and said, what is the current cycle versus that? And it was an eye opener. Okay, because if you see stocks which are even 10,000 crore to 25,000 crore market cap, okay, is not 23%, but here on an average, all stocks within this uh, band, okay, have fallen 36%, right? And if you went to anything which is sort of 5,000 crore or lower, right? So you will find that those stocks have actually fallen 50% or more. So the point that one is making is the small cap rally has been, so the small cap stocks have seen a very, very sharp cut. And that also brings us back to, so when looking at contrarian and when looking at market cycles, etc., I think data throws us a lot of information. And this analysis is actually as of 30th of November, right? So, and if it's 30th of November, December also saw further cuts. So probably, the worst is gone, worse than 60% in terms of a fall. So you'll probably be much closer to the 2018 to 2024. So I would, step back and say, and if this is the large, quantum of fall, where do you think, these stocks will go? How do you think these stocks will do? And my gut feel and the guess is, and also looking at past data, I think is that possibly small caps also, are closer to the end of their correction. Okay, so here I'll request Tara to come out to the poll. In this session, I'll also see how much of crystal ball gazing all of you can do, and this is the first one to say, where do you expect markets to be, end of 2026? Okay, so do you expect to fall? Do you expect to be flat? Do you expect to go up by, I've kept 15% as the threshold bands. I will give a few more seconds for people to, you know, poll. Yeah, thank you for, I think, a very good participation. Thank you. Uh, I'll end, oh yeah, I'll share the results. Okay, so interestingly, if you see, uh, 10% expect a fall, 40%, 41% expect it to be flat, and 49% expect markets to go up by over 15%. So that's an interesting and reasonably bullish view from all of you. Thank you for sharing. So what is our view, right? So one is I gave you this whole responsibility of crystal ball gazing. Okay, so what is basically our view? First of all, I think Indian equities, in line with what you all have also polled, we expect Indian equities to be, very strong in this calendar year. We think emerging market equities also should be sort of relatively strong. Of course, they have done well, so maybe some bit of correction out there. Developed markets, we expect it to be, relatively sideways. We may see rallies and pullbacks is what a little bit of the thought process is. Okay, but still, I think broadly one may, expect one doesn't expect markets to sort of crash in developed markets either. So it's still a sideways to possibly up within that band that we gave of say 15%, right? So that is something that we expect there. Now gold, you'll wonder, it's confusing. There's a arrow upwards and also sideways. Okay, what we are saying, like gold and silver. So the point one is trying to make is we think both gold and silver will do well, but there could be intermediate corrections or there could be slowdowns that we see at some points of time. And so that is broadly long-term bullish view, but in the short term, we think that you can see some bit of corrections, and corrections are also healthy because it ensures that you don't get into bubble territory, and then the falls also don't are not as extreme. Fixed income, we think, will sort of uh, continue to be where it is in terms of returns, and possibly if interest rates are also coming down, that could be marginally higher, but we think that it will be flattish to positive there. And REITs also, they saw a very good run up. Here I'm talking about Indian REITs, okay, which are sort of listed on the exchange. And so we think, again, flattish to, a little up. Okay, so that's the view that we have there. Coming back to, large cap versus mid cap versus small cap. Okay, interestingly, we are saying our outlook is overweight on all, which means we are bullish on all the three categories. Large caps, their valuations are reasonably attractive. Okay, because they didn't participate too much and earnings has grown in that period. So their valuations are relatively attractive. So we expect a PE expansion on the large cap side, but mid cap and small caps, one sees that earnings growth is continuing to be likely to be strong. Okay, so mid caps have already come back in terms of earnings growth, and we think small caps also will come back and be strong as we sort of go forward. Uh, just to give you a bit of our perspective, so that you think how we are sort of looking at it in terms of sectors. Okay, so it's capital markets, and we also capture some, a little bit commentary on what we think are the sectors that are likely to do well, etc. Okay, so you'll find that interestingly, capital markets saw a reasonable fall, in Jan to March of 25, and that was linked to a few, SEBI related actions in terms of the futures and options side. They were tweaking things around, and also there were some announcements that sort of came in, multiple things which sort of impacted the sector. And but through that we went and added. Okay, so we took a bit of a contrarian call there. Uh, Now consumer durables, which was sort of relatively stronger for us, we sort of eased off. Okay, consumer services also, which was strong for us, we sort of trimmed. Okay, healthcare, especially hospitals, we are increased our weightage and continue to be bullish. Capital was actually, we are not necessarily bearish on it, but I think it's more that when you reallocate to certain sectors where high conviction is there, like capital markets, then it has to come from somewhere. And capital goods was one of the places that we sort of took out, though we think it will continue to sort of do well. IT, we had a low weightage, so we sort of uh, and because of the correction, we sort of came back and increased a little bit. But, but I think some of the others have been relatively, stable as to there. But we've tweaked around things on a marginal basis, and sector like FMCG, we've also reduced in some form as we expect, some bit of move upwards. Okay, so what are the upcoming themes and upcoming trends that we are sort of looking out for in 2026 and beyond? And uh, the key growth drivers that we see, right, is around. So of course there are other like demographics and broader, growth cycles, infrastructure spending, and stuff like that, which one has sort of covered in the past. But I'm saying one of the some of the trends which we expect to be relatively strong, and help you if you are looking at stocks and sectors, etc., then which are the places that you could also look at. Okay, one is we think the financialization of savings, where is likely to be a major trend where there's already been some bit of move away from traditional assets like, let's say, real estate and FDs, etc., into, of course, FD itself is a financial asset, but away from physical assets into financial assets. So that's one thing. The second is about there is going to be a continued renewable energy push. Okay, private capital expenditure has been weak, but we think now that will sort of come back. And so this is something which will be sort of beneficial to banks, etc. And defense spending, we think that, while defense stocks, etc., also took a bit of a pause along with other PSUs, we think that defense spending will continue to be strong, and, consequently, that sector should do well. You look at lower interest rates is something that we are expecting and continue to expect. Okay, and that will be broadly positive for markets. If you go back and see, the key reasons why US did well in the last decade was, on the lower interest rate regime that they had. And the other is, with respect to India, is about premiumization, where, the higher end, so you'll find that whether it's watches or, accessories or anything, you'll find that premiumization is a trend that, is likely to be strong within, the consumer segments. And we also think the other growth driver is going to be GST and income tax rate cuts, where there's more money in the hands of the people, and that part of it will come towards spending or investing. Okay, both of which will be sort of beneficial to markets. Now, coming back to the sectors that we think will sort of do well, wealth management is sort of one sector. And if you see the wealth to GDP of India is relatively, smaller. The share of financial wealth is, very low. And, professionally managed wealth also is very, very low. So all of these factors we think is going to see a rapid expansion. And this has been the case, especially, when you look at markets like the current, one, okay, where you will find that people will start or be willing to go to professionals as the wealth goes up. And this is a trend that you see when an economy also grows from a 2 trillion, say, to a 5 trillion. So these are all trends that sort of also correlate with other markets. Ones like consumer discretionary, fashion retail within that is something parallel, especially. So what we're saying is branded fashion retail, right, is something going to be a trend which is sort of going to grow reasonably strongly. And that you have seen with companies like Trend, they have brands like Zudio, etc., which have done very, very strongly. And and so apparel is something that we think will sort of continue. And again, it's a move towards branded stuff. And you see that this theme towards branded will also sustain into the jewelry side, which is what, from the unorganized jeweler, you're finding all branded, jewelry shops which are sort of coming back and ruling the roost today. Uh, the other part of it is you have iPhones and some of the laptops and many other electronics goods which sort of get manufactured in India. So electronic manufacturing services is something that we think will sort of do very, very well. And part of that is based on a trend that a lot of the MNCs are looking to de-risk from China. Okay, even if it is a higher cost, their point is they've seen supply chain disruptions in COVID, and they want to de-risk from such supply chain issues. So, which is why I think India is going to be reasonably well placed within this segment, because there are going to be other countries as well, but India is sort of gaining on this trend, and some of the government policies like Make in India, etc., have were very timely, and there are also subsidies that sort of come in for these manufacturers. Of course, some of them are the ones which are sticky points, in our trade negotiations with the US. But the nevertheless, I think that this trend is likely to sort of continue. And We also look at India from the underpenetration or of hospitals. I think that will also uh, we need to increase it in line with the WHO standards of 3 per 1,000 people. We are now 1.3 per 1,000 people is the number of hospitals that are there. And of course, we've been seeing a lot of hospital chains, etc., do and expand and do well. I think COVID gave a bit of a booster and created awareness, and so this is something of a trend which is also likely to sustain. Defense, of course, I think the Indo-Pak War also was something that I think everybody globally, the various countries, you know, were able to see our defense prowess, and that is something that's likely to, um, over the next few years, do very, very well. Uh, so, what are we doing on our portfolios, and how are we looking at it? Our view is that control what you can, the controllables, right? So these are our portfolio fundamentals, which means these are the earnings of the underlying of the stocks that we hold. Okay, the weighted average based on the holding that we have. So you will find that the profit growth uh, that we are seeing for our companies continues to be very, very strong. And one of the best correlations. So when I'm saying control the controllables, best correlation to stock market or stock price return is the earnings growth, right? So we think that when earnings growth is strong, you will also see stock price also move in a favorable direction. And what are the few themes and few trends, that we should be sort of looking at? Uh, in fact, over the last few weeks, I started writing and sharing my views on LinkedIn, and some of these are captured there in more detail with charts and rationale and stuff. So, if it's something that you would like to do, you can definitely go and see some of those uh, posts that I made. So the first one that I'm saying is that earnings growth is likely to drive domestic market revival. So and I think that strong earnings growth will and always reflects in the performance of underlying stocks. So that's something that we expect to happen in 2026. The currency, we also think now. I'm sticking my neck out. Okay, a lot of NRIs just come and have good fights with me. Okay, and but saying that for the last so many decades, India has depreciated. Actually, data, if you go back and look at data, there are periods where the currency is appreciated also for a long period of time, and some of it can even could have lasted, over a decade with some pullbacks at various points of time. So I think as India does well, we believe that the currency will also appreciate, and for 2026 itself, one believes that the currency will be strong and will appreciate. I'm not even saying say stable. I'm saying will appreciate versus the dollar. Uh, now we'll have to see how that pans out, and I think time will tell. End of 2026, we'll probably look back at all of these. And the other aspect is in terms of gold, silver. Like I mentioned earlier, we are positive, but we expect volatility maybe somewhere like Q3 or so. No, sorry, Q2 possibly or so. And so that is something that we watch out for. One expects not only when earnings the growth is there, we have P ratios at favorable levels. Okay, we think that FIs also will come back strongly. Okay, and you'll find that emerging markets also, not only into India but also other emerging markets, we think will continue to do well. Okay, so now that's also a good and bad thing, because if you look at a market cycle for a larger global, say, downturn, typically you'll find developed markets do well, then it moves on to emerging markets, and then you have the big correction. So that's something that we'll be watching out for. Hopefully not in 2026, but possibly that will something that we will be keeping close watch on to see where globally things deteriorate. Okay, so I did speak about small caps, and because it's fallen so much, okay, and this is a normal cycle to see that and we've seen that happen in the previous cycle. the corrections are much stronger than what we have maybe perceived it to be. Okay, and so that is why, so when you look at the underlying data, we think that we are closer to the bottom, and we expect a broad-based rally as well. So not only small caps, but even mid and large caps will also do well, we believe, in the 2026. Okay, so the other one where we've been having good conversations with clients is the ones who are holding AI stocks. Now we have two sets, interestingly, some of our clients who are actually in AI businesses and key roles in AI businesses, they themselves are seeing risks. Okay, and by in very senior roles, in strategic roles on the AI side, they also believe that there's some bit of froth which is there, so one needs to be a little bit cautious. So, and again, we are not saying that, I'm not saying this month, next month, I'm not saying 6 months as well. I'm saying over the next 18 months, I think that's something that we have to be looking out for. Okay, so this is the broad trends that we are seeing sort of in markets, and global as well as India. Okay, so this is something that, but more focused. This is more focused towards India. Okay, but that's something that we keep in mind. And how do you position your portfolio, right, for the next decade, or the next year? Okay, so one is India equity versus global equity. Yes, global equity has done very well. We think that India equity will come back and be in the top few in this calendar year. Equity versus precious metal. I would think that equity would do reasonably well. Of course, you have commodities like silver, which are maybe high risk, high return type of investment opportunities. And one keeps in mind that commodities like silver, unlike gold, they are more consumption driven. Okay, and so demand and supply driven, whereas gold also is a safe haven. Silver, even though it's a precious metal, uh, because of the volume, okay, it's difficult for, let's say, central banks to hold it as a reserve, because they will require that much more of storage space. Okay, is not as suitable, and which is why you know it 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 will work more in line with the other metals than gold, even though there are points of time when both of them converge. Okay, large caps versus small caps and mid caps, we think that large cap will continue to do well, but the earnings growth is likely to be not likely to be as strong as the mid and small caps. But like one mentioned, they would benefit from PE expansion, and when that happens, we'll probably see a little higher than just the earnings growth in the case of large caps, whereas mid and small caps will also be driven by earnings growth itself, while the PE expansion may not be sort of as large as what we think of the large caps. But we think still there also there should be some PE expansion, but may not be to the magnitude of large caps. And gold versus silver, I already did discuss that, gold also is a hedge against volatility, whereas silver is, a commodity asset based on demand and supply. So it's the commodities are cyclical in nature, and that is something that we need to sort of keep in mind. Again, these, maybe over 2 3 years, at least over 2 years, we think that gold and silver should continue to be relatively strong. Um, in terms of the big question, AI versus and in the US, what should one be investing? The tendency is to chase the best performing stocks. The tendency is to, like even yesterday, Rachna was telling me that, an investor said they want to invest in Nvidia, right? So those are things that you must keep in mind, that whenever the cycle turns, the largest fall will happen within those stocks. The trends and the technology growth will continue. Okay, like we've seen always in the past, including in the previous digital boom that was there, also was the case. But the stocks, depending on whether they're able to continue to sustain the earnings growth, right, is something. Plus, there's always a risk of disruption. Let's take Nvidia itself. Uh, you know, Basically, if you look at a stock like that, and this is not a recommendation for you to buy or sell, but I'm just using it as an example. Now, it's in a very disruptive tech sector, and so tomorrow, if you find some of the other companies are able to come back and deliver chip capabilities, if companies from China are sort of also able to come in and close the gap in terms of technology advancement. Okay, then in the AI space, then you may AI related chips. So then you may just find that suddenly things may change, and that's always the case wherever you have a shortage type of scenario. You find over periods of time, supply also comes in, and that changes things up substantially. So I'm just using it as an example, but that is something that we are just saying that we think in the short term still that technological superiority is there, but over a period of time, technological superiority doesn't last. Okay, so which is why that's something that one sort of keeps in mind. So in a scenario like that, AI chips will only grow, but there will be between companies, there's going to be disruption that happens. Right? So coming back to what is the portfolio strategy that you can adopt? Okay, we think that Indian equities is good for top ups and fresh buying. In fact, through lump sums. Okay, uh, and we believe that it's also time we can start doing it, including in mid and small caps in lump sum. Normally, we are very great proponents of SIPs, but I think in this point of time, seeing the large fall, uh, I think they will do well. However, you may find that in the extreme short term, you don't know where exactly the bottom is. So that is something which you will have to brace yourself for some short-term volatility from where you invest. Okay, the MSCI emerging market index, we think that has done very well, took partial profits, but continue to be significantly invested in. Okay, if you look at developed markets, I think we are of the view that you should be slowly booking profits and moving away. And I'm just saying, from countries like the US, right now it may sound unbelievable, but that's something that we do expect. You'll not only get returns in the underlying stocks, but you will also benefit from a rupee appreciation. Okay, of course, if the rupee appreciates for a much longer period of time, it's also negative for the Indian economy. But I think that's something that we will watch sort of and keep track of when we get there. So gold and silver, we are saying that because volatility is expected due to SIPs, fixed income, continue your asset allocation, maintain your asset allocation. I think fixed income is something you should do, and REITs and InvITs. Okay, we also saying continue asset allocation. So in summary, and the takeaways. Uh, we believe that it's about balancing risk and returns. Okay, and the year, yes, has been in roller coaster back to where we were maybe a year back. Okay, there have been geopolitical conflicts. There have been Trump tariffs have been grabbing headlines, and interestingly, on both of them, there is some anticipation of some resolution, whether it's a trade treaty with the US, okay, and whether it's a truce in Ukraine. I think the second one is more difficult than I think what people expect it to be. Okay, but definitely, that is something that at some point one hopes will get resolved. Okay, Indian markets have seen a time-wise correction. Okay, Nifty and mid cap is back to the peak, but the underlying has been, not necessarily as in line with the index. Okay, so the small caps have seen very sharp cuts, especially where the market caps are lower. Uh, so macro parameters, the great part of macro parameters for India continue to be strong, and so that's the base thing that supports us. Domestic inflows, SIPs continue to be strong, and when there is buying support from domestic investors, it's unlikely that markets fall. Our portfolio stocks we continue to look for stocks with earnings growth, and it continues to show, positive and good earnings growth. Lump sum investments, like I said, can be considered, including in small cap stocks. And uh, I have given my cautionary note on AI based, stocks. And and I'm saying 18 to 24 months is a period. The issue that you have is, it's very difficult to again predict the exact peak. Okay, which is why I would like to start early and do phased wise. As the stocks go higher, those are points to book profits, and convert to real money, because there have been in the past periods when people have saw a lot of paper money and then it just disappeared. So just keep that in mind, because many times, once the values have become high, I think the point is to conserve that value rather than make more money on top of it. Okay, so this is a thought that I would leave some of you who have on the stocks with. And as usual, I think I would like to end by saying keep in mind the basics on financial planning, asset allocation, discipline investing, managing risk, and definitely you will do well.